Good morning, everybody. This is Ryan Moe standing in for Joe Vaklovic, who is on vacation this week. It is 5:23 a.m. this morning, and we have markets that are down once again. December corn is down a half cent here, and November beans are down 2 3/4. December wheat down 6.5, and Minneapolis wheat is also down about 3, with Kansas City down about 6.5. Energy prices here are leading the way with crude oil down almost $2. And we got some of the equity market futures up a little bit higher here. We got some wild stuff happening in the marketplace here that took place over the weekend. McKinsey, kick us off with our lead story about Monday's price action.
So, trade was shocked by Monday's price action. With all of the major geopolitical events that took place over the weekend, many expected a bullish reaction. Instead, futures in energy and grains got weaker and weaker as the session wore on. Crude oil attempted to rally late on Sunday night and rallied to highs not seen since January, but after Friday's close around $74 was taken out on the chart, sellers came in and hit the crude market pretty hard, with energy markets unable to sustain support. Grains and their loose affiliation due to biofuels succumbed to selling pressure as well.
So, this is an extremely hot button issue, and it's sensitive on all sides. But what we only want to look at here is analysis over the market's reaction to the events that unfolded. The latest is, as of last night, President Trump has announced a ceasefire between Israel and Iran. It appeared that both had agreed to the ceasefire, and other nations around the world applauded this ceasefire as Israel and Iran were projected to head back to the negotiation table. This morning, though, the latest that we're reading out there is that it's being reported that Israel's defense minister is saying that Iran violated the ceasefire and is ordering more intense strikes upon Tehran. So at 5:25 a.m. Central Time, those strikes do not have appeared to have happened, but this is a very quickly unfolding story. Just a few short years ago, this would have been something that would have been extremely bullish. And when we think about how things have changed here in 2025, it does appear that the market believes that there is enough diverse sources of crude oil that the world will maintain plenty of supply, and supply shortfalls, if they do occur, will only be short term. Or it could also mean that the trade is of the belief that it could trigger a economic weakening of some sort. However, the equity markets are not really behaving in such a way, so we have to wonder if there is some changes for that. When we go and look at the charts, we see that markets rose on Sunday night up to the $78 mark, which is something that had not been seen since January. However, as the day continued to unfold, we started seeing that the foundation of that market started to weaken. And then with its inability to hold, and it took 3 to 4 shots at the close of Friday's trade. And then eventually, about 11 a.m. Central Time, those old uh, closes were not able to hold, and the market just gave way, and everything broke loose with it. Corn was a little bit early. It preempted the crude oil fallout, but once crude fell, then corn fell, and then it was just a cascading effect from there. So we have to go ahead and see how this is going to go ahead and play out. Interestingly enough, diesel fuel prices, if you look at where they are at from the highs that were set on Sunday night to where they're trading at here this morning, we're off darn near 40 cents in that marketplace. So we've got a lot of things going on in the energy marketplace. It's something that we definitely have to stay up to speed with, and market watchers will be watching this extremely closely. We also had our crop conditions report out there. What
We
did
sure
that tell us,
did. So,
McKinsey?
U.S. corn crop conditions declined for the first time this season. As of Sunday, 70% of the crop was rated good to excellent nationally, down from 72% the previous week, but still above the 5-year average of 64%. Within the Corn Belt, notable week over week rating declines were observed in Indiana, Kentucky, and Nebraska. Outside the region, crop conditions fell sharply in Colorado, Texas, and North Dakota. Meanwhile, the U.S. soybean crop held steady at 66% good to excellent, above the 5-year average of 63%. Despite the majority of Corn Belt states experiencing a decline in their weekly soybean ratings, only Michigan and Ohio reported ratings below the national average.
So, Mackenzie, was it 100 degrees where you were at over the weekend?
No, because I was actually up in Wyoming all weekend. But yes, my dad told me here in central Nebraska it was blistering hot.
Yeah. So one has to wonder if seeing some of the rolling coming from that didn't actually have a pretty significant impact on this as crop watchers were looking at things on Sunday. We have to ask ourselves the question, though, was this heat actually good for this crop? The crop had been behind on heat units, and we seem to be wanting to catch up. So, with this being the case, did it maybe look bad for the day? Yes. Did some of the heat actually help the crop? That is my belief. However, when we go to looking at conditions and what they're looking at from a 5-year perspective, this crop is still in pretty good shape. A great start matters, although a great start doesn't always correlate to high yields or strong or good yields. We're not quite far enough into the crop year yet to where those start to really matter. However, we're getting closer and closer to that. For soybeans, it's still definitely far too early to tell. We have a great start as it sits right now, but we all know soybean crops are made in August, and we are quite a ways off from August. But as it sits today, we are in a pretty darn good spot. How about the wheat markets? What do we see over there?
U.S. winter wheat ratings declined for a second straight week. As of Sunday, 49% of the crop was rated good to excellent nationally, down from 52% the previous week, but still above the 5-year average of 44%. The rating fell below analysts' expectations of 52%. The crop was 19% harvested nationally as of Sunday, up from 10% the prior week, but trailing the 5-year average of 28%. U.S. spring wheat conditions declined for the first time this season, with 54% of the crop rated good to excellent nationwide compared to 57% the prior week. The rating fell below analysts' expectations of 57%, but matched the 5-year average. Montana and South Dakota were the only states with ratings below the average.
So I will admit that when it comes to trading wheat, I am a bit of a novice. When I was younger in the trade, um, getting started in the wheat market was really difficult because there were so many guys that had 20 years experience ahead of me that they had established good client books, and there was really no room for a 23-year-old Iowa State grad with less than stellar GPA. And so, as my friend Mike O'Day says, he goes, wheat trades on 3 different exchanges and multiple protein levels and delivery points. So, ladies and gentlemen, trade wheat, and the rest of you just trade pig feed. And I've never been accused of being a gentleman. So, this pig feed trader just simply asks his friends, and what did my friends say? And my friends that I met with in Montana last week told me that they had great moisture through the fall, but this late drought has just absolutely kicked their butt. Then there's an old term in wheat that if you spit on it, it'll grow. But however, my friends are telling me that those wheat crops are a little bit too far gone at this point. And so some of these conditions that are holding true, it's going to really actually hurt yields out there and hurt the crop that at one point did have great potential. How about export inspections? What do we got happening over there?
U.S. corn shipments were strong once again last week. USDA reported that 58 million bushels of corn were inspected for export during the week ending June 19th. The print was down 13% compared to the previous week, but up 28% versus the same week last year. Soybean shipments fell below pre-report expectations at 7 million bushels. The print was down 14% compared to the prior week and down 45% versus the same week last year. Wheat shipments were near the lower end of expectations at 9 million bushels. The print was down 34% from the previous week and down 26% versus the same week last year.
I talk about it a lot in the presentations that I give. Export inspections are more important than export sales. The thing with export sales is they can be canceled. The thing about export inspections is they're loaded on a boat and they are gone almost never to be seen again. 99% of the time they're gone and they're gone. They almost never come back. And so that is very significant. And when we look at this export inspection situation in corn, we are exceeding all expectations, and we had some pretty darn lofty expectations to begin with. This is a very, very good thing, and this is a very, very important thing for the markets moving forward, because we are going to need to continue this export inspections pace coming into the next year. And there's going to be some challenges associated with that because we're so heavily dependent upon one customer, which is Mexico. We got a premium video coming up here later in the week, and that's going to be something that is going to do a little bit of a deeper dive into the relations with Mexico and Mexico's other options for corn, both domestically and from other foreign suppliers. And we want to make sure that we continue to have very, very solid trading relationships and partnerships with Mexico, because as you can see from this chart here, we're extremely dependent upon Mexico for export inspections and sales. Soybeans, they're just naturally leveling off for this time of year. And so when you see the soybean progress and you don't see much of a report, don't get too bent out of shape about it, because this is the way it's supposed to be. And with the size of the crop that's coming out of South America, this is one of those things that the fact that we have any soybean export inspections at all is largely positive. CFTC reports are telling us what?
So during the week ending Tuesday, June 17th, large money managers were net sellers of 19,000 corn contracts. The net short of 169,000 contracts is the largest since early September. The funds were net buyers of 27,000 soybean contracts and 13,000 contracts of SRW wheat on the week. The net short position in SRW wheat contracts now stands at 74,000 contracts, the smallest since early February.
For corn, we can no longer say that the size of the fund position is indecisive. And that's something that I think is very significant, because if you look at this data, and I have a major frustration point with the CME and the CFTC about the fund positioning report, because this is data that is now a week old, and we got our first opportunity to trade it here yesterday afternoon or last night. When we're looking at the data and the way things are in 2025, we have the ability to update a fund position report daily. We could do it more regularly than that, but we don't need to go that far. However, when we're looking at what the sell-off that's taken place here since this data was released, we probably have closer to 200,000 on the corn position, and that is no longer an indecisive position. The funds have made the decision that they want to be short this corn market. The weather is supporting that position. And when you look at the spread market is also supporting that position, because with the July-September corn spread collapsing here over the last few days, what we can see is that the funds are now going to be able to roll that position that was going to be at a loss, a penny for penny loss. When you look at the inverse, we're now looking at a very small inverse of only a penny and a half. And that is not a loss that's substantial enough to go ahead and get the funds to break their short position here. When we look at the bean market isn't quite as decisive as the corn is, because they want to go ahead and continue to hold a bit of a long position coming into the unknown weather season, but also with the boost that they've gotten from the biofuels market here in the last couple of days, or excuse me, the last couple of weeks. When we look at the wheat markets, it's just a dog. They want to go ahead and be sellers of wheat, and that is just the way that they want to go ahead and play things. Anything going on out there in the livestock markets or cattle markets that we want to add
Cattle
to here,
futures were
Mackenzie?
mixed on Monday. Live cattle were 72 cents lower to 65 cents higher. Feeders saw gains ranging from 35 cents up to $1.30. Box beef prices were mostly higher on Monday. Choice was down 28 cents at $3.90.22, but Select had a big day, gaining $6.15, rising to $3.83.10. The Choice Select spread has now narrowed to $7.12, the tightest so far this year.
All right. So as we look at markets here, before we go ahead and wrap up, corn is actually battling right back to about the unchanged market. Beans are following along with it, but they're having a hard time shaking bean oil that's still down just about a penny. Wheat markets can't seem to get anything going here as they continue to go ahead and be weak. Equity markets a little bit stronger as we enter into the trading day, with the Dow futures up 375. Gold markets getting absolutely hammered, down 1.61% at about $55. As we look at the rest of the marketplace here, we have a lot of volatility coming our way. Who knows what the rest of the day is going to bring us, but happy trading out there.